Welcome to Business Engineering and thank you for joining us. This is the third presentation in our Basics of Business series. This presentation furthers the high-level understanding of business by exploring various types of business ownership. Let's check it out. Business engineering tackles complex management, technology, and business topics. We are unique in that we provide analysis and meaning by leveraging executive experience, evidence-based research, and doctoral-level academics to give you working knowledge to improve your business. The key points we will explore as our research questions are: what are the 7 popular types of business ownership? What are their common and differentiating characteristics? And what are their pros and cons? To tackle this topic, we will review what is a business and what is a corporation. Then we'll explore the various types of business ownership and corporations, identifying their advantages and disadvantages, and then end with a summary. Let's start by summarizing what is a business. A business can be defined as an organization or enterprising entity that is engaged in commercial, industrial, or professional activities. Businesses are often associated with aspects of research, design and development, production, and distribution of goods and/or services. Businesses generally deliver their product, which can be goods and/or services, in exchange for a fee. Let's next summarize what is a corporation. A corporation is a form of association or organization of persons and material resources chartered by their respective state or nation for the purpose of conducting business. They are acting under law or a legal construct as a single entity, having continuous existence, holding powers and liabilities separate and distinct from their members. Let's take a look at the popular types of business ownership as well as their advantages and disadvantages. 7 types of business ownership which we will discuss are sole proprietorship, partnership, limited liability company or LLC, limited liability partnership or LLP, Co-Operative, C Corporation, and S Corporation. A sole proprietorship is generally what the term identifies, the most basic form of ownership where one sole person is the owner or proprietor of an unincorporated business enterprise. The business is not registered or structured as any other business type, therefore, this is the default position of business ownership. In this type of ownership, there is no separate legal business entity. The person and the business are legally one and the same from a financial, taxation, and liability perspective. This also means the personal assets of the owner are not protected and are fair game against any claim of debtors and liability lawsuits. In some cases, this business type is considered a hobby business, especially if it is semi-recreational. The relative attributes or pros and cons of a sole proprietorship are: starting the business is very simple and low cost. There's essentially zero corporate governance. The breadth of ownership is 100% that of the sole proprietor, but selling or transferring the business is not a clean or prescribed process. The capitalization generally comes entirely from the owner or from funding sources such as personal loans, bank loans, unsecured loans, credit card debt, family loans, and the like. The ability to attract outside capital investment is very low. In operating the business, the owner has 100% span of control, and the control complexity is very simple. Whatever the owner chooses is the operating direction. From a liability perspective, the owner has 100% investment risk, including the obligation to return of any private capital if the business fails. The owner's liability for lawsuits and debt is unlimited, and the owner's personal assets are also fair game for settling any such obligation. Taxation of the business is very simple. The owner reports any income directly on their personal tax return, but may be limited as to which expenses are deductible for the business. The tax rate is that of the owner's tax bracket. The business is not double taxed on profits, but the owner must pay any self-employment taxes on the income. The second type of business ownership is a simple partnership. A partnership is similar to sole proprietorships, but structured for multiple people. There are different types of partnerships, and we will present 2 examples. The first example is a general partnership. This is where all partners share control and liabilities, sometimes in equal proportion, or other times the proportion is aligned with their proportion of investment, operating control, and share of the profits which they agree upon in a partnership agreement. Next is limited partnerships. One partner has unlimited liability but greater control. The other partners have limited liability, generally up to their investment, and limited control. In some cases, these are considered as silent partners. A silent partner can be described as an investor that provides capital and places full confidence in the general partner's ability to operate and grow the business. Ultimately, a silent partner is one who still shares in the profits and losses of a business, but is not involved in management or operations. The relative attributes or pros and cons of an unincorporated partnership are: starting the business is still very simple and low cost. There is essentially zero corporate governance other than a recommended partnership agreement. The breadth of ownership is 100% that of the partners. There may be opportunity for disagreement, and therefore it may be important to identify a mechanism up front to mediate such disagreements. Selling or transferring the business is also not a clean or prescribed process. Similar to a proprietorship, the capitalization generally comes entirely from the owners or from funding sources such as personal loans, bank loans, credit card debt, unsecured family loans, and the like. In general, there is a benefit of leveraging both partners' assets. However, the ability to attract outside capital investment is still very low. In operating the business, the complexity is low. The partners have 100% span of control. This may be a 50-50 split or whatever role and division of operating responsibilities the partners choose. From a liability perspective, the partners have 100% investment risk, including the obligation to return of any private capital if the business fails. Unless specified otherwise, the partner's liability for lawsuits and debt is unlimited, and each owner's personal assets are fair game for settling such obligations. Taxation of the business remains simple. Each owner reports their share of any income directly on their personal tax return, but together they may be limited as to which expenses are deductible for the business. The tax rate is that of the owner's tax bracket. The business is not double taxed on profits, but the owners must pay any self-employment taxes on the income. The next type of ownership is that of a limited liability company. An LLC is where an individual operates a business activity. However, it is structured as a separate legal business entity, like another natural person. One key feature of this situation is that a separation of distinction now exists between the owner's personal and professional assets and liabilities versus that of the business. LLCs do not pay corporate federal taxes, as does a regular corporation, but they are considered as self-employment, so the owners must pay both sides of the self-employment taxes, meaning the individual component and the employer component. The net earnings from the LLC carry through to the owner and is taxed at their individual tax return. The relative attributes, or pros and cons, of an LLC are generally very advantageous. Starting the business and incorporating is moderately simple and modestly low cost. There is a low corporate governance, although some rules must be followed to maintain transparency and afford protection of the corporate veil. The breadth of ownership is 100% that of the owner. Selling or transferring the business is not as easy as selling registered shares on a stock exchange. However, it is a cleaner process as the LLC is a self-contained entity. Similar to a proprietorship, the capitalization generally comes entirely from the owner. The ability to attract outside capital funding is higher than that of a proprietorship, as the LLC has the ability to borrow money based upon corporate performance and credibility. In operating the business, the complexity is low. The owner has 100% span of control as long as they operate within the constraints of the LLC laws and any related operating agreement. From a risk perspective, the owner has 100% investment risk and may have obligations to repay any personal loans secured in establishing the firm. However, any loans taken directly against the LLC have the liability limited to the assets of the LLC if the business fails. The owner's liability for lawsuits is limited and does not pass through to the owner's personal assets. Taxation of the business remains relatively simple. The profits are not double taxed. The owner reports any net income directly on their personal tax return, but has far more latitude than a sole proprietor as to what business deductions may be paid by the corporation prior to taxation. This also helps the owner to reduce their tax rate and the level of self-employment taxes owed. Limited liability partnerships. An LLP is where partners operate a business activity. However, that business activity is structured as a separate legal business entity. One key feature versus that of an unincorporated partnership is that a separation and distinction now exists between the owner's personal assets and liabilities and those professional assets and liabilities of the corporation. LLPs do not pay corporate federal taxes as does a larger corporation, but they are considered as self-employment, so the owners pay both sides of the self-employment taxes. The net earnings from an LLP carry through to the owners and is taxed at their individual tax return rate. Similar to an LLC, the relative attributes or pros and cons of an LLP are very advantageous. Starting the business and incorporating is moderately simple and moderately low cost. A partnership and an operating agreement must be established and followed. There is low corporate governance, although some rules must be followed to maintain transparency and afford protection of the corporate veil. The breadth of ownership is 100% that of the partners. Selling or transferring the business is not as easy as registered shares on a stock exchange. However, it is a cleaner process as the LLC or LLP is a self-contained entity. Similar to an unincorporated partnership, the capitalization generally comes entirely from the owner or from funding sources such as personal loans, bank loans, credit card debt, unsecured family loans, and the like. The ability to attract outside capitalization is higher than that of an unincorporated partnership, as the LLP has the ability to borrow money based upon corporate performance and credibility. In operating the business, the complexity is low. The owners collectively have 100% span of control, or individually, as their agreement defines. The operation is simple as long as they operate within the constraints of the LLP laws and any operating agreement. There may be opportunity for disagreement, and it may be important to identify a mechanism up front to mediate such disagreements. From a risk perspective, the owners have 100% investment risk of their combined investment and may have obligations to repay any personal loans secured in establishing the firm. However, any loans taken directly against the LLP have the liability limited to the assets of the LLP if the business fails. The owner's liability for lawsuits is as limited and does not pass through to the owner's personal assets. Taxation of the business remains simple. The profits are not double taxed. Each owner reports their share of any net income directly on their personal tax return, but has far more latitude than a sole proprietor or an unincorporated partnership as to what business deductions may be paid by the corporation prior to taxation. This also helps the owners to reduce their tax rate and level of self-employment taxes owed. A cooperative or co-op is a privately held incorporated business that is typically owned and operated by the individuals who utilize its product and/or services. An example may be that of a small telephone company serving a rural community or a condominium complex. The purpose of a co-op is to serve the needs of the people who own and/or operate it. Since a co-op is an incorporated entity, liability of the members is limited. The co-op's profits are reinvested into the business or distributed across the user owners. Starting the co-op business and incorporating is far more complex than that of an LLC or LLP and incurs considerably more startup cost. There is also far more governance complexity. The breadth of ownership is 100% that of the combined user-owner members, who are generally highly engaged. Selling or transferring ownership shares is not as simple as on a stock exchange, but is much easier and can be prescribed by the co-op agreement. Capitalization is broader. Capitalization likely comes from the collective user-owner members, yet the ability to attract outside capital investment is higher as the co-op has the ability to borrow money based upon corporate performance and credibility. In operating the business, the complexity is moderate. The combined owners, users, members collectively have a 100% span of control. However, all of their inputs must be considered in a voting process or proxied in an agreement. The operations must adhere to the co-op laws, rules, and any related operating agreement. From a risk perspective, the totality of owners have 100% investment risk of their combined investment. However, the distribution of risk is spread across a much broader base, with many forces working to ensure success of the co-op. All loans taken directly against the co-op require liability of the co-op to repay those obligations. However, the liability does not pass to the personal assets of the owners. Taxation of the business is more complex than that of an LLC or LLP. The profits are not double taxed, expenses are deductible before profits are declared, and the owners are only taxed upon their direct share of income. The largest type of business ownership is that of a full-scale stock corporation. This is a C corporation. Examples could be General Motors, IBM, Microsoft, and Amazon. The term C relates to the subchapter of the IRS taxation code. The business entity is entirely apart from its owners, limiting personal liability to that of their investment. The business is operated with professional management and a paid governance board. The owner's responsibility is to pay for their stock, vote when required, and the owner may enjoy profit via dividends and stock value appreciation. Starting the business and incorporating a C corporation is highly complex and incurs large startup costs. There is generally a requirement or need for professional management and formal governance, such as a paid board of directors to represent the stockholders. The breadth of ownership is 100% across that of the shareholders. Management presents initial and annual plans for approval to the board of directors. Upon approval, management is essentially given custody and budget of executing such strategic and tactical plans as approved by the board. However, management must meet operating targets, such as earnings per share each quarter, and any significant deviation which arises must be approved by the board. Transfer of ownership is very simple and comes in the way of publicly trading shares on a stock market or exchange or through the purchase of treasury stock directly from the company. The company may also offer stock purchases through a DRIP program, which is an acronym for Dividend Reinvestment Program. Capitalization is very broad and comes from the shareholders. The purchase of stock can be held by thousands of shareholders, and corporate bonds may offer loans. The ability to attract outside capital is very high. Also, the corporation may secure loans from banks and other institutions. Large institutional investors, such as a pension fund, often seek this type of investment vehicle. From a risk perspective, the totality of owners have 100% investment risk of their combined investment. However, the distribution of risk is spread across a very broad base. Owners may sell their shares easily or purchase more to meet their investment needs. Taxation of the business is very complex. The profits are double taxed. The corporation pays taxes at the corporate rates on the profit, then that profit, which is distributed to the shareholders as dividends, is also taxed again on the individual's tax return. An S corporation is a type of special, smaller-scale stock corporation. The term S relates to the subchapter of the IRS taxation code. Shareholder liability is limited, and the key benefit is while the firm and the profits are small, the business avoids double taxation. Profits are passed through to the stockholders and taxed on their individual returns. Limits and circumstances apply. An example of this type of corporation may be that of a fast-growing regional construction firm. Starting the business and incorporating an S corporation is highly complex and incurs large startup costs. The corporation typically features professional management and may require formal governance in the form of a paid board of directors to represent the stockholders, especially as the firm grows. The breadth of ownership is 100% across that of the shareholders. Similar to a C corporation, management is given custody of executing strategic and tactical plans as approved directly by the board of directors or under a proxy arrangement. Transfer of ownership may come by privately traded shares or negotiated agreements of an asset exchange. An S corporation is generally not publicly traded. Capitalization is moderate. An S corporation is a good vehicle for attracting an appropriate number of limited shareholders. The ability to attract or secure outside capital is moderate. The corporation may secure loans from banks and/or other institutions. From a risk perspective, the totality of owners have 100% investment risk of their combined investment. However, the distribution of that risk is spread across a broad base. The owners are fully insulated from the debts and liabilities of the company beyond the loss of their investment. Taxation of the business is very complex. An S corporation may enjoy no double tax and a pass-through arrangement, such as an LLC, while it is a small number of investors and a small amount of revenue. However, with more revenue and a larger investor base, the model moves to that similar of a C corporation, where the corporation pays taxes at corporate rates on the profit, then the profit which is distributed to the shareholders as dividends is double taxed. There are other corporate structures which exist, but will not be covered in depth as they generally don't relate to mainstream for-profit enterprises. One is that of a nonprofit or not-for-profit, a tax-exempt corporation to serve the common good. They are not taxed, but their requirement is to return all profits back into the organization. A B corporation. This is a for-profit corporation that is chartered to provide public benefit, but may enjoy less reporting requirements than a C or an S. A closed corporation. Similar to a B corporation, stock is typically only offered and held by people closely related to the business. This presentation has served to explore the research questions and identify 7 different types of business ownership, their common and differentiating features, as well as their corresponding pros and cons. Evidence from research shows that selecting the optimal type of business ownership is important for structuring your business for long-term success, protect your assets, optimize your tax strategy, and minimize your reporting workload. Professionals are available worldwide to assist you with this task. Thank you for joining us.